an event organized by the Asset Owners Committee, CFIA Spain. Many of you know who we are, but the committee works just for family offices, foundations, endowments, insurance company, today, and sovereign funds. This is our third event in the year, so we started the year just covering behavioral finance advice to pension funds with Professor Diego Valero. A couple of weeks ago, we had Ruiz, it was the ex-vice president of the MNC, and explained to us the role of endowments, was quite interesting. And today we have Paul Barnes to talk about insurance company. What is an insurance company? Maybe not so basic, but it's going to be quite interesting. Main difference with banks, why they don't default never. At least is what I have in my mind, and it should be. And as I mentioned, it's going to be really interesting. Paul is the CEO of current company Financial Europe. It's based in France, and it's the subsidiary of the American company, Cohen Company. I said that they run the business like Apollo. They do it even with more excellence, but they are smaller. Right? It's a really big company, and it's the person that every insurance company CFO has to be advised by. We have the pleasure to have him here with us and to share the knowledge with us. We are more than 20 people here in the room. There are both people from the Portugal Society, France, Switzerland. Very happy to share this event with them. Just your turn, Paul. Thank you very much for coming.
Gracias, Pedro Pablo. Eso va a ser mi única palabra en castellano, que en el pasado hablé castellano, pero se fue, no sé dónde, pero ya se fue. So I'm going to now start this module presentation in English. We're going to talk about insurance today, and especially about investing in insurance. Before we start, I will mention that our presentation will be mostly focused on a debt instrument issued by insurance companies. Why? We could also talk about equity investments, but we'll figure out that, I'm sorry to say that, I know some of you work in insurance companies. Insurance company shares are hardly sexy. If you want to get share exposure to the insurance sector, you should focus on insurance brokers. You can get big multiples. Insurance companies hardly trade significantly above NAV. They trade basically between 80 and 120% of NAV, sometimes below NAV. So we talk about debt instruments issued by insurance companies because this is really a big market, and we think it is a very important and interesting market for asset owners and investors worldwide. I'd like to start. Thank you. This is state-of-the-art technology. Right? We were discussing that with Wiz before and with some people here. Whenever you make a presentation, you need to say that you focus on AI and state-of-the-art technology. So we'll be talking about three different things. First of all, what is an insurance company? In case some of you only know about insurance but don't really know all about insurance. And I will focus on some very specific issues and characteristics of insurance companies. Secondly, I will say, why do insurance companies issue debt instruments? And secondly, probably the part that you're mostly interested in, what are the main risks and what are the main benefits of investing in insurance debt instruments? So first of all, what is an insurance carrier or an insurance undertaking? Insurance undertaking is a definition of Solvency II, so that's why I'm mentioning it here. An insurance undertaking is a company that creates and sells insurance products to take on risks. By definition, an insurance company needs to be related to some form of risk. If there is no risk, it is not an insurance product. There needs to be an insurable risk in an insurable policy. And they sell that in exchange of a premium. The purpose for the policyholder is to reduce its financial uncertainty. And that's basically the goal of insurance. Insurance started with marine insurance, at Lloyd's of London a few centuries ago in a pub where basically you had merchants shipping very valuable goods very far away. At the time, you basically had a 25% chance of losing the shipment. So you had to pay insurance, and at the time, insurance premium were very, very, very big, okay? So today, you have two main forms of companies that provide insurance to their clients. You have stock companies that are privately held, like any normal corporation. You have shareholders. And then you have all sorts of mutual insurance companies. Mutual insurance companies are not privately held. Practically speaking, they belong to no one. That's why in so many countries you have sometimes politicians who want to basically take the net asset value or some of the net asset value of those mutual or whatever they give, can be a cooperative or whatever form, but in all cases, it's an entity that is governed by its policyholders, but not really owned. Okay, it is important because you will see they behave somewhat differently. In all cases, those insurance carriers are heavily regulated. In Europe, for the last 10 years or so, we've been governed by Solvency II. Before that, it was Solvency I. And each country has its own slight specific way of regulating those companies, but the framework is extremely similar from one country to another. And basically what Solvency II brought compared to Solvency I is a risk-based approach. So everything that insurance company does is linked to a risk that is as adequately as possible weighted by the regulator, and that basically inures a capital charge to the company. Now I'm going to discuss about two things that are very specific to insurance, unlike corporations and unlike banks. And this is one of the main themes I want to address today. There is no such thing as financial institutions. I think this is a word that we should get rid of because banks and insurance companies are extremely different. The first specific of an insurance company explains why it almost never defaults. The reason why it almost never defaults is because of what we call in English the inverted cycle of production. In Spanish, I think you call it el ciclo de producción invertida. What does it mean? In a normal corporation, you start by incurring expenses. If you look at, a supermarket, you need to build a supermarket. Okay? You need to hire people. That is an upfront expense. Then you buy goods and then you sell them. But you need you need to initiate the pump. Okay, so you basically incur your expenses before you generate some revenues. In insurance, it's the opposite, and this is very rare. As a policyholder, you pay your premium day one, say the 1st of January, for a risk that would typically occur over the following 12 months, from 1st of Jan to 31st of December. On average, the claim or the loss will occur on 1st of July, in the middle of the year, okay? You have several kinds of insurance classes. You have the short tail classes and the long tail classes. Short tail classes, a good example would be health insurance. In countries where basically you have a social security that is highly dependent on IT system, basically the claim is automatically transferred to your mutual, to the social security. You can get your repayment within a few days. That's the shortest tail business. Then you have motor bodily injury. So, when you break your car, that's the spare part. That will be paid to you after a couple of months. Then you have homeowners. When you have a leak in your roof, you typically need for the walls to dry. It can take up to 6 months. And at the very, very end of the spectrum, you have everything that relates to bodily injury. So when you have a car crash and someone is injured, on average, if it's like a seriously bad injury, it can lead to what we call PPOs in the UK, periodic payment order, up to 50 years long. Okay. casualty business, especially in the UK, in the US, when you have asbestos claims, that could be 20 years plus. In the meantime, what does the insurance company do? It sits on the cash. So you receive your payment day one, and on average, you'll pay the claim 3-4 years later, on average, right? If you look at corporations, non-bank, non-insurance companies, between 80% and 90% of the defaults, delinquencies come from a shortage of cash. You may run a very profitable business. If you run out of cash, if the bank cannot support you, you're dead. An insurance company always sits on a huge amount of cash. This is one of the reasons why so few insurance companies default. The second thing that I want to emphasize about insurance companies, and that is specific to insurance companies and make a big difference to banks, is that insurance companies have what we call gluey or sticky liabilities. You know, they stick, you cannot get rid of them. This is very different from banks, and that's why I don't like the word financial institutions. If you have deposits in your bank, you can take that money whenever you want. That's what basically killed Silicon Valley Bank in March 2023. Why? People withdraw their money. You cannot withdraw your money from a non-life insurance company. It's all driven by statistical events and non-discretionary events. You have a car crash, unless you make a fraud and want to get your money back from a car that is over $1 million. There's no way you can actually drive when you will have a car crash. Same thing with leakage in your roof, etc., etc. There is an exception, though, with life insurance companies. You can pull out your money out of a life insurance company almost whenever you want, but there are tax consequences. So usually there is a tax hurdle or tax incentive to maintain the money within the life insurance company for a certain amount of time. So typically for policyholders who hold a life insurance policy, that will be the longest tail saving that they have. They will always pull the money out of the bank first and out of the life insurance company later. This is a crucial and very big difference between a life insurance company and a bank. To give you an idea, in 2009, I think, there was something that you may never have heard of called, it's a bank that existed in the Netherlands, the DSB Bank, founded by a policeman called Dirk Scheringa, DS, that stood for DSB in the DS for the DSB Bank. And they got a fine because they were selling mortgages, and they were trying to sell the death insurance alongside with the mortgage. Everybody does that. All the banks in the world do. But you always need to leave the optionality to the borrower to seek for insurance elsewhere. Like all Dutch insurance banks, they got a fine. The fine was small, 200,000 euros. The large banks got millions of fine. Those guys got 200,000 euros of fine. And in a popular TV show, a presenter said, "Oh, you know DSB Bank, they're fraudulent, those guys. They're trying to sell insurance products and they make it compulsory. They don't have the right to do so. I suggest everybody on TV watching me takes their money out of DSB Bank." The next day, there was 1 billion euros of withdrawal. The Dutch National Bank had to intervene. And then the guy on TV made another speech, and you know what? Not only are these guys crooks, but they are linked to the regulator. I suggest we take our money out again. And the Dutch National Bank basically decided that they should leave the bank, go bankrupt, and not intervene because they would be taking too much risk. This is something that cannot happen with an insurance company. And although what I'm mentioning here is kind of a detail, that doesn't happen very often, but it happened in the past, and it happened again in March 2023, when there was a lack of trust intervening with Silicon Valley Bank. So 2 things that you should always remember about insurance companies: they always sit on a huge amount of cash, and they've got sticky liabilities, right? Pasivos viscosos. As a consequence, you have this slide here. insurance companies do not default. On average, over the last 30 years, 1 in 1,000 company wind up. The winding up is a definition of EIOPA, which is the European Association of Insurance Regulators in Europe. And basically, it's a concept that is wider than default, because you can wind up without defaulting, because not all insurance companies have got debt, so they cannot default. It's basically the intervention of a regulator saying, you have to stop. So either you have to merge with another company, or we withdraw your license and you run off your business. On average, in Europe, for the last 30 years, only 1 in 1,000 insurance companies have defaulted every year. 0.1%. I cannot think of any other industry in the world that is safest to life insurance in Europe. Okay, so that's a very important thing to say. If you look at other areas like the US, AM Best, which is a rating agency specialized in insurance companies, they rate about 90% of all insurance companies in the US. The average, they call it impairment rate, which is similar to what we call here the wind-up rates, is about 0.5%. So it's much higher, but it is stable. If you looked at the same statistics with banks, so I'm sorry, I think in the US it's 0.3, not 0.5. 0.5 is what you find with banks, but there is a major difference. Here you see it is extremely stable, no matter what period you look at. With banks, you would have 0 and sometimes a big peak. Savings and loan crisis, very massive increase in defaults. The great financial crisis of 2007, 2009, you had huge default among banks, especially in the US. So this is the specific about insurance companies that never default, and the low default rate is extremely stable. Now, second point, why do insurance companies issue debt instruments? I've mentioned to you before, the first main characteristic is they sit on a huge amount of cash. If you are cash rich, you don't need money. So why do you borrow debt? Okay. The answer is easy. They don't borrow debt for cash purposes, they borrow debt for capital purpose. So the kind of instruments that this company issue are typically what we call subordinated debt. In the US, they call it trust preferred securities when it's issued out of a holding company, or surplus notes when they're issued out of an operating company. It's the same concept, basically. It's a debt instrument that is structured in a specific way so that the regulator will give it regulatory capital treatment. And the rating agencies will typically give them equity treatments as well. So it's debt, but it's treated as capital. Why? Well, capital is always a debt. The equity of a company is the debt that you have vis-a-vis your shareholders. So in this specific case, it's a debt that you have vis-a-vis your subordinated note holders. But it's a debt that can be treated as capital. The key characteristics is very long maturity, so typically 10 years for tier 2 debt, perpetual for tier 1 or alternative tier 1. It has a bullet repayment, so there is no amortization of principal. You only pay for the coupons during the life of the bond, and you make one big capital repayment in the end. You have the ability to defer interest payments. That's the main difference between subordinated and senior debt. In subordinated debt, you need to get regulatory capital treatment to insert the ability for the issuer to defer interest payments. Nowadays, on the Solvency II, that deferral option can only be triggered by factual events, such as a shortage of capital. So if your what we call SCR ratio falls below 100%, you have to defer. Otherwise, you cannot defer. SCR ratio is a ratio where the numerator is the available own funds of the company, and the denominator will be what we call the SCR, Solvency Capital Requirement. So the amount of so how much capital you have divided by how much capital you need. Okay. By the way, for banks, that ratio is about typically 120%, 130%. For insurance company, on average, it's about 200%. I'm just mentioning this. You also have the ability to absorb capital losses. That's only true for tier one instruments. And there is no covenant. On the Solvency II, you cannot have any covenant. In Bermuda, which is one of the two countries with full Solvency II equivalent, the other one is not the US, the other one is Switzerland. In Bermuda, you can have affirmative covenant. So nothing that would breach an event of default, but you can have a covenant where if you don't meet that covenant, then the coupon will step up, will increase. That's all you can do. And that is not possible in Europe. Subordinated note instruments are very popular among insurance companies. Why? Because they could be treated as capital, but they're much cheaper than equity. They're not dilutive for shareholders. I mentioned to you before, you have two kind of form of insurance companies. You have the stock companies. You also have mutuals. For mutuals, it's the only way they can quickly raise capital. If they want to improve their capital ratios, mutuals can only lower the denominator. The only way to increase, the numerator is to issue tier 1 or tier 2 debt instruments. And they are additive to most other ways to reduce the denominator. To reduce the denominator, you can de-risk your investment portfolio. You can bring diversification because correlation is a very strong improvement in your capital calculations. You can de-risk your investment portfolio. So you can actually relatively easily reduce the denominator. You can also reduce your business, so you can reduce premium, etc. But I don't even mention that. So, the one I forgot. You can buy reinsurance quota share. A reinsurance quota share, for those who are not very familiar with reinsurance, is a way to basically carve out vertically everything or part of your portfolio and give it to a reinsurance company. Automatically, if you, for example, cede 20% of your business into a quota share reinsurance treaty, that will reduce more or less your capital requirement by almost the same amount, so by 20%. So for small companies that start, reinsurance quota share is a very efficient way to actually get more capital, or put it this way, to reduce your capital requirement. Now, this is a slide, it's a little bit technical, but it's basically a way for you to better understand how much subordinated debt an insurance company can issue. Depending on the tiering, so the tier 1 capital can represent, so the tier 1 subordinated debt can represent up to 20% of the equity. And the others, the tier 2 and tier 3, can represent 50% of the solvency capital requirement. What it means is we are mixing different denominators, but what you have to remember is if you use the full buckets, what it means is you can represent, you can issue subordinated instruments up to 60% of your capital requirement. And with tier 2 debt only, which is basically available for everyone, tier 1 is only available for the big guys, because a tier 1 instrument is a perpetual instrument with no incentive to redeem on the 10th anniversary. And basically you shake hands with the issuer. And because he's a repeat issuer, you trust him that he will always redeem the debt on the first date that he can, which is called the first call date, typically on the 10th anniversary. And people trust him because he's a repeat issuer. And people know that if he doesn't do that, it will be more difficult for him, if not impossible, to issue more debt instruments in the future. That applies to AXA, Allianz Generali, Mapfre, but not to a small mutual in Southeast Valencia. I have nothing against Southeast Valencia, by the way, I'm just mentioning it, okay? So if you're a regional mutual, you cannot issue tier 1, forget about it. You can only issue tier 2 debt instruments, okay? So you can see subordinated debt instruments can be a big share of the capital requirement of an insurance company. That's why it's such a big market. I've here listed some of the main uses that you can have. You can issue debt to basically support your organic growth, to support M&A, to give a big capital buffer, especially mutuals. Mutuals cannot issue equity. So if you can issue sub debt, basically it's a good way for them to say, okay, whatever happens, I will always be above the 100% threshold that I need. if you use a lot of reinsurance quota share, you can increase your retention. Usually you give profit to your reinsurers, right? So by retaining more business, you can retain more profit. And by the way, subordinated is always much cheaper than reinsurance quota share. And you can also use it if you are, for example, an MGA, or I said to you before, if you want to invest in equities, you should invest in broker equities. Sometimes brokers can be very big, very successful, and they want to retain some of the business that they see and start their own insurance companies. That happens in the UK, that happens in the US, less on the continent, but it can happen. In which case, the company will be very happy to basically support the initial capital of the company with subordinated debt. And also, whatever happens, it's a very good way of reducing the weighted average cost of capital. Because if you look at public listed debt, I'd say the average cost would be today around 5%, maybe 6% for more recently issued securities. The weighted average cost of capital of those companies is probably more in the double-digit range. So a good way to reduce your weighted average cost of capital is to issue Tier 2 debt and optimize your capital position. Now, third part of this presentation, we'll look at the risk and benefits of investing in insurance debt instruments. So after the first two parts where I looked at, I try to put myself in the shoes of an insurance company. Here, I will put myself and yourselves in the shoes of an investor in instruments issued by insurance companies. What are the main benefits and what are the main risks? To be negative or to finish with the good bits, I will start with the risks, okay? So these are the main risks. Maybe you have more, but let's look at these first. The first risk is you're talking about long-dated instrument. To be treated as capital, you typically need tenure. The regulation says minimum 5. From a practical standpoint, the expected maturity of most debt instruments issued by insurance companies is more 10 years. Okay, so this is long-dated. What does it mean? And typically, they are fixed-rate instruments for the first 10 years. And when you have either perpetual securities or longer dated securities, those who typically need a rating from S&P, for example, are 20 non-call 10. Okay, those instruments would be fixed rate for the first 10 years. And if not called on the 10th anniversary, which is very rare, they're always called usually, they become floaters. Okay, but at least for the first 10 years, they are fixed rate securities. So if you buy them at the beginning of 2022, and you suffer from a massive raise in interest rates from 0 to 4%, as we saw in 2022 within a few weeks, that can really destroy a lot of value. Okay, that's the main negative point about those fixed rate instruments issued by insurance companies. There's a couple of mitigants. One is, especially for the perpetual bonds, if you miss the call, at least after 10 years, they become floaters. And, you know, when I was a kid, a large part of, the main investors, the pension funds, for example, would invest in govies, right? Because they needed long-tail assets. Govies were ideal. That's when govies yielded 5%. Until recently, between, during the 2010s and until 2021, govies yielded nothing. So the large investors like the pension funds had dramatically reduced the weight of their long-dated portfolio because they had dramatically reduced the weight of their govies. And they were using financials that as a good replacement because that yielded more than zero, okay? So when interest rate rose again, we saw a massive comeback of large investors to govies because they needed more govies, right? They wanted more govies. They wanted to restore their asset allocation to what it was like 10 or 15 years ago. Another negative is the subordination. There is no surety, no pledge, no covenant in a subordinate debt. So I said to you before, defaults are very rare. That's true. But recoveries are also supposed to be low as well. One mitigant, though, is a subordinated debt is not like a mezzanine debt, right? A mezzanine debt is an instrument that is issued by a plain vanilla corporation, where you'd have equity, mezzanine, and senior debt, and sometimes senior secured debt, whatever. You have several levels of senior debts. But that mezzanine is usually squeezed between a large senior debt and a small equity. With subordinated debt, it's very different because it is not subordinated to any other form of instrument. If you look at the liabilities of an insurance company, you have equity, sub-debt, and no senior debt. If you see senior debt in the balance sheet of an insurance company, run away. There should never be senior debt on the balance sheet of an insurance company. I saw once that in a UK-based insurance company, they did what's called ATE, standing for after the event. It's basically a very strange policy where you basically have somewhat fraudulent solicitors in the UK say, oh, you've had an accident with a whiplash. You know, whiplash is when someone bumps into your car from behind and your neck does like this. It's fine, you get nothing. 2 days later, you have a solicitor who makes a publicity in a newspaper and said, you know, you can claim something from that, right? Maybe £1,000, £1,000. I'll do it for free, no cure, no pay. So you have a lot of claims like this, and the solicitor can actually buy an insurance premium in case he recovers nothing. That specific of that insurance policy is that you have an upfront cost, right? So the insurance company basically gets its money back in the end when the claimant potentially gets recovery from that insurance company. It's the only kind of insurance policy where you don't benefit from the inverted cycle of production, okay? So I quietly stayed away from that company, and guess what? It defaulted a few years ago because that's the only insurance company I knew that did not benefit from the inverted cycle of production and that did not sit on a huge amount of cash. The third item that is a risk is the deferral option, right? So if you count on the coupon to basically calculate your cash flows, well, guess what? It can be deferred. Now, for tier 1 instrument, it's not deferred, it can be canceled. For tier 2 and tier 3 instruments, it can be deferred, but it will be paid. In most jurisdictions, the deferred coupon itself bears compounded interest. So you don't lose money, you just defer the payments of that coupon, right? And the other mitigant about this is that it is extremely rare that an insurance company actually breaches its SCR. In all our funds, that happened once for 1 quarter, okay? Just because the company had under-reserved and they decided that they needed to inject more capital. It took them 3 months to inject capital, and the situation was restored. That company is just fine now. But for 1 quarter, they skipped a payment, and the following quarter, they made 2 payments. So it's not a major event, but you have to remember that this option exists. For tier 1 instruments, you have loss absorption features, which are somewhat discretionary. So you sometimes need like a certification signed by 2 directors of the company saying that if that loss absorption mechanism is not triggered, the company may go bankrupt, okay? But this is an important one. That only affects alternative tier 1 instruments. Depending on which jurisdictions, sometimes you have them, sometimes you don't. But in all cases, that is an important feature. That was recently triggered with banks, not with insurance companies, but in Switzerland that was recently triggered. The last item relates to correlation. I want to mention it here because it's a question that is always raised. I have a different view on this, but sometimes people say, well, I don't want to invest too much in insurance because what happens if there is a major shock affecting the entire insurance market? And you sometimes see deep pocket investors like pension funds having up to 25, 30, or 35% of their assets invested in financials. And they say, oh my God, it's highly correlated. To which I reply, yes, it's correlated on the paper, but there is no correlation between banks and insurance, and there is no correlation about insurance companies. Well, let me phrase it differently. There is no correlation among non-life insurance companies. What is the correlation between an insurance company doing pet insurance in the UK that covers, veterinary expenses, with a company doing homeowners in Northeast Italy, or medical malpractice in Lyon, France, or in workers' compensation in the Netherlands? There are hundreds of examples like this. There's about 3,500 insurance companies in Europe. Okay? Many of them are specialized in one area or in one sub-industry. When they issue sub-debt, there is no correlation among them. The only correlation among insurance companies is among life insurance companies. Life insurance companies are correlated, that's for sure. And that could be problematic, especially in case you have a sudden and massive increase of interest rates. I'll come to that in a minute. If you look at 2022, the preceding 10 years or so were marked by low to negative interest rates. So if you look at the chart, I want to commit now, actually, because it's a mitigant. If you look at this, and you could actually have gone a little bit backwards. You had a very low and very stable interest rates during almost 10 years. What does it mean? When you're a life insurance company, gradually, to gain business, you had to guarantee zero to your policyholders. But you may say, why on earth would I give money to someone who guarantees me a zero return? Well, because that's the guarantee. You get your capital back. When you invest in equities, you can lose money. That insurance company will guarantee that at least you'll get your money back. But you have to agree that it's not a very sexy message, right? You give me your money for 8 years, I guarantee that you'll get your money back. Well, that's what they guaranteed. Having said that, it's usually distributed more, 1, 2, 3, 4%, depending on how much they make. Because typically, life insurance companies guarantee a low rate, but they distribute typically like 80 to 90% of whatever investment return they generate. But still, on the face of the policy, it's a 0% guarantee. So when you're here at the beginning of 2022, you've basically accumulated for the last 10 years assets that yield nothing, especially when you invest in governments. And suddenly, when interest rate spike like this, from -0 to 4% within a few weeks, what happens? Any other competitive financial offer can yield 5%. What do? You cancel your life insurance policy and you go and invest in something else. In every country, you have some deposit with a guaranteed of 1, 2, 3%, whatever, right? Or you have another life insurance company that will guarantee you 2% or 3%. Or you buy unit-linked products. Or even you can buy money market funds that will yield you much more than what your life insurance company is guaranteeing. What is the problem? It's called the mass lapse effect. That is extremely stressful. Why? Because suddenly, if you have long-dated assets and interest rates have gone up by 4% roughly, if you have a 3-year term, you lose 12%. So you have to basically honor policies with a guarantee of 0. So you have to reimburse par, but you lost on average 12 points. You cannot do that. Besides, what Solvency II does is that under Solvency II, at any point in time, a life insurance company has to be able to redeem 40% of all its liabilities at one specific point in time. To give you an idea of the magnitude, 7% lapse is high. 40% is a never-seen level. But Solvency II requires every life insurance company to have enough capital to withstand that. So, why did I skip to slide on page 18? Because what I want to say is, this is the biggest crash test that I've ever seen in my life. For life insurance companies, you cannot imagine worth. I've been investing in insurance for 20 years. I was the CFO of a reinsurance company before, and I've talked to many regulators. We have invested in 18 different countries in Europe. Every time I meet a regulator, I always ask him the same question. To you, what is the major risk that the insurance industry is facing? And I always get the same answer, which means they talk to each other. A sudden and sharp increase in interest rates that would dramatically affect the life insurance sector. If you looked at the solvency financial and condition reports, the SFCR, produced by insurance companies, they have to produce it every year and make it available on their website. What you will see is that typically, before that happened, they were testing like a 50 basis point increase in interest rates, sometimes 100. We've seen 400 increase. Okay, so why do I mention this? Because I want to say this is bigger than any crash test anyone could have thought of. In the meantime, there was almost no insurance company in Europe that defaulted. I can think of one in Italy, Eurovita, but that's because it was very poorly managed. Okay, so yes, life insurance, there is correlation and it could be dangerous, but still, having said that, we saw a big crash test in 2022, and that did not affect the industry as a whole, and it certainly did not affect non-life insurance companies. I mentioned life insurance companies, that's the main problem. I don't have the exact number, but out of memory, between 80 and 85% of all outstanding debt instruments issued by insurance companies have been issued by life insurance companies. And there is correlation among life insurance companies. They hardly default, like non-life, but they are somewhat correlated. So one good advice, if you want to get the lower correlation as possible, try to optimize the book of non-life insurance debt that you have in your portfolios. And life insurance companies are more complex. My boss said to me, Paul, investing in insurance is so easy that even you can do it. It was a joke, but he's right. When I look at the life insurance company, I always start by scratching my head. When I look at non-life, after 5 minutes, I already have a precise idea of how strong the company is. Non-life, it takes days and days and days. And after we've made our analysis, if a fairy came to me and said, you got it completely wrong, I would not be surprised. So you always have to be humble when you look at the life insurance company, because it's got a very complex business model, and it's very, very difficult to get precise information at looking at the balance sheet or even at looking at a rating agency report. So now let's look at the benefits. First benefit that I mentioned before, probably the most stable and the safest industry in the world. On average, only 1 in 1,000 default in Europe. In the US, it's about 3 times higher. So European insurance sector is really strong. And if you compare it with banks, you get higher default rates and much more volatility. Benefit is, as mentioned before, the blue sticky liability. Never forget that. That is extremely different from with banks. And I mentioned to you before, non-life insurance companies are completely decorrelated. I mentioned here, for your information, I made this slide when I was in a train. I didn't have access to the internet. Just by brainstorming myself alone, I found 18 different subclasses of non-life insurance, right? And I'm sure we could find more, okay? So I'm specifically used to investing in niche businesses. These are niche businesses that exist, and we have probably invested in every single of those subclasses as we speak. This, again, is the crash test. So if I were to give you an advice, if you ever see a sub-debt issued by the non-life insurance company, it should be really worth at least looking at it, because it will not be correlated to anything else. It should have a high return, and the probability of default is going to be super low. Last slide, which is the specific. Now we're talking niche of the niche. These are rare instruments, but if you ever found them, they are great. If you are an insurance company yourself, and if you invest as an insurance company, the cost of capital in investing in a debt instrument will be a function of two things: the remaining duration and let me just delete this, and the credit quality step. The credit quality step is a function of the rating, right? If you're AAA, AA, credit quality step 1. If you're in the single A range, credit quality step 2, etc., etc. Now, if you're not rated, the instrument is not rated, the cost of capital is not that high. But if the instrument is not rated and it has been issued by an insurance company, there's a loophole. Article 180 of the Delegated Acts of Solvency II says that you can derive the credit quality step from the SCR ratio. You remember that SCR ratio that I mentioned earlier in the presentation? Numerator is the available own funds, denominator is the capital requirement. On average in Europe, let's say that ratio is about 200%. If you are at or above 196%, you will be deemed as credit quality step 1. So if you buy a bond, a subordinate debt instrument issued by a non-rated insurance company whose SCR ratio is above 196%, and there are thousands of them, the cost of capital will be as if you invested in a Coca-Cola bond. Well, Coca-Cola may not be as safe as it was before, but as any AAA rated bond. Okay? So that's another benefit that you get if you are an insurance company and you want to invest in such securities. So very low cost of capital for Solvency II insurance companies investing. Is Kata?
It's good.
Okay. No, let's do this. Okay. So as a summary, before we take questions, insurance companies almost never default. Despite this, they pay higher coupons than banks. I forgot to mention that in the presentation. If you look at the spreads of insurance company subordinated debt versus bank, you can have, on average, at least 1 or 2 points of difference. It doesn't make any sense to me. It just doesn't make any sense to me. If you just look at the likelihood of default, it's a no-brainer, take the insurance debt. Now, the bank instruments may provide liquidity, but that's it. That's all I can see. Non-life insurance companies are not correlated among themselves and not correlated to life insurance companies. Life insurance companies have some degree of correlation, although, as mentioned, they also never default. So you should always look at the possibility of diversifying among non-life insurers. I mentioned mutuals before. Mutuals are not very successful, typically. They don't produce high returns. There is good reason for that. They don't have shareholders. So the closest concept you can find of being a shareholder is being a policyholder. So you have basically a company that is more or less owned or governed by its clients. So it cannot charge too much money to its policyholders. Otherwise, it would be taking too much money from the people who govern them. So a 5% return on equity for a mutual is okay. So if you could invest in equity, which you could not, because you don't have equity, well, you don't have shares in a mutual, I would advise you to stay away from that. But if you want to be a debt investor, that's usually a very good story. Why? Because they don't take, on average, okay, they don't take too many risks. And if something happens, they can be merged. I have seen in several circumstances a regulator stepping in and say to the Doctors Mutual, oh, by the way, I've got a very good M&A case for you. The Pharmacist Mutual is going to merge with you. And you say, well, they're not that rich. They're in a difficult situation. Yes, but you're a true entrepreneur, Mr. Smith. I've always considered you as an entrepreneur, and you will merge with that mutual. And these are live examples that I've seen in my career. Mutuals never default because they don't take a lot of risk. And when they have difficulties, they are merged, like in a forced wedding. And on the opposite side of the spectrum, I have seen some, especially small privately owned non-life insurance companies. In the UK, you can think of Admiral and others like this. These can be very sexy business case as an equity investor. As a debt investor as well, but that's probably the only case where I would be tempted to invest in equity as well. If you like insurance, if you want to focus on insurance, and if you have equity to spend, focus on the brokerage side. If you want to invest debt, I would say debt instruments issued by insurance companies are a great asset to invest in. Focus as much as possible on non-life. It takes some life as well, because otherwise you won't have enough money to invest. There are not so many non-life instruments available on the market. I think I've covered everything that I wanted to mention. It's been 45 plus minutes. Please feel free to ask any question. Can they ask questions?
Yes.
Oh, I have to stop sharing. Is there any?
Yeah, well, I have a question. I think you mentioned that the insurance company pays more than banks. And what about the non-insurance company? So as they pay the same as, yeah.
So you mean the corporates?
Yeah, no, I mean the insurance company, the non-life. So you mentioned that there are different types of non-insurance.
There is no difference in spread between life and non-life. The main driver is size. There is an illiquidity premium. So if you issue, so what we call a benchmark deal is north of $250 million, 250 million. Below that, your sub-benchmark, there is a liquidity premium. So in the firm that I work with, we focus on small and mid-sized insurance companies that do not have access to capital markets. So all sub-benchmark deals. Average spread is about 6%. Benchmark deal, the spread is about 2%. There is no difference between life and non-life. Okay. So the main driver will be size and rating, of course. So I'm talking rating equivalent. But if you look at a bond that would be, so an issuer rated single A minus, for example, you have a lot of them. The sub-debt instrument would be 2 notches down, so triple B flat. A triple B flat bond the size of 100 million will pay probably at least 75 to 100 basis points more than a bond with the same rating, triple B flat, but with a quantum of 250 million or higher than that. The main driver for the pricing is the liquidity, so the size of the bond. You know, when you issue a small debt instrument, you're hardly covered. When you issue a big one, you can be 10 times covered, oversubscribed. That's because of the liquidity. Luis, you wanted to ask a question?
Yes, Berkshire Hathaway. Why does no insurance company, operate the company as they do? It's because of regulation?
No, it's because Warren Buffett has a very good phrase. He says, "I know nothing about insurance." Okay? It's completely wrong, but at least that's his speech. He said, I mentioned the inverted cycle of production. That's why he bought an insurance company. And he's basically saying, all I want is my insurance companies to generate cash at no cost. The KPI for that is called the combined ratio. The combined ratio is the sum of 2 ratios with a different denominator, right? I'm getting too technical, but practically speaking, the numerator are the costs, so claims and operating expenses. The denominator is the net premium income. So if that combined ratio is below 100%, you have less expenses than you have technical income. It's all about technical, so I'm not including the investment return. So what Warren Buffett says is, give me a company with a combined ratio below 100%. That way, the technical income, which is basically premiums minus claims minus expenses, will be above 0. In the meantime, that is a machine that generates cash. I don't know anything about insurance, but God, I'm a good investor, and I will invest the proceeds. He did it for such a long period of time that, and he's been such a good investor that he generated a lot of additional return. And this is basically available capital above the capital requirement. One thing I mentioned about the combined ratio, and something you should not forget, when I mentioned the presentation here, but what's ready to push? This one?
Yes.
Yes. If you look at the long tail and the short tail thing, you will agree to this. If I run long tail business, say 10-year tail business, what it means, to give you a magnitude of the balance sheet and P&L differences. If I have a company writing 10-year business with 1 billion of premium every year, after 10 years, roughly, I would have 10 billion in my balance sheet. 10 billion of technical reserves, 10 billion of assets. To run that business, I will have a certain level of capital. But if I run my business at the combined ratio of 100%, it means I generate cash for free. But each euro of premium will gradually generate 10 euro of invested assets. So I can actually run my business at a combined ratio which will be significantly above 100%. You get my point? Because then the investment return component will be a very, very big component of my profitability. Whereas if I write very short tail business, like health insurance, for example, there's almost no investment income. And that means I need to run my company at a combined ratio significantly below zero if I want to remunerate my capital. This is very important. So to answer more precisely, Warren Buffett could not start again that business and just focus on the investments unless he started the company with a huge amount of excess capital. It's just because he started the company such a long time ago and was so successful that gradually, he basically generated a huge amount of excess capital. A few years back, he basically said that for the first time ever, he will make dividend distribution and buy back some of his shares. He's saying, I don't know what to invest in now. I have just too much capital. I will return some of that to our shareholders. You wanted to ask a question?
Yes. Is that the same idea behind the acquisition or the combination of Athen with Apollo? It's basically a cash out?
Yes, but with one difference. Berkshire Hathaway is integrated. Apollo basically, and you have other examples, that's what we call the hedge fund insurance companies. You basically have an asset manager who says, insurance, I don't know much, but I want to start a company, especially a life insurance company, and I will manage the assets. A portfolio manager can make 1 point, not more, 1.5, sometimes 2 points on managing the assets. So if you look at the magnitude, a life insurance company, if it has unit linked, can have 50 times its capital in balance sheet items. If it's what we call the euro policies with a guarantee, it's up to 10 times. So for each euro of capital, you have 10 euros of investable assets. Let's talk about the company with 1 billion of capital. 1 billion of capital, if it's all euro policies, let's say you have 10 billion of assets. You make 2 points on 10 billion, that's 200,000, am I correct? That's 20% of the capital of the company. So even if the company is not profitable, as an asset manager, you make 20% return by just managing the assets of that company. So this is why sometimes, you said before, we're like a small Apollo, sometimes you have a very strong conflict of interest. I would not like to be a co-investor in an insurance company whose majority shareholder is a hedge fund and whose assets of the company are managed by that hedge fund. Because what he gets, you don't see it. 20% of the return, 20% return equity, you don't get it as a side pocket investor. What they do is mostly to manage the assets. It's a good policy, but then you probably don't want to be a co-investor with that company because the hurdle, the profitability hurdle for those guys is extremely low on the technical side. So if you carve out the revenues they can generate by managing the assets, that company will hardly be profitable. But it's a very successful business model for them. Yes?
Yeah, I have two questions. One, just wanted to get your views on the future consolidation on the European insurance market. And the second one is related to the tier one instruments. Do you think it could happen something like it happened to Credit Suisse, where they get kind of wiped out and the equities to Luxembourg?
So for the people online, the first question relates to consolidation, and the second question relates to potential loss absorption mechanism on tier one, like for Credit Suisse. So for the first question, consolidation has occurred already. It's still ongoing. But when I started my career at Cohen & Company, that was 20 years ago, I went to see the French regulator. And I said, hey, guy, I'm bringing capital to your industry. I was naive at the time. I was 34. Now I'm 54. I'm not less naive. I thought the guy would welcome me and say, oh, Paul, it's so good to have you. You're bringing capital to the industry. The guy was really upset with me. And I could see that the reason is, he said to me, you know, today in France, there are 89 disability institutions. These are form of mutual for workers' compensation in France. He said, that's far too many. There's about 10 now, so 9 times less. And officially, the regulator is saying if you don't have a 10% market share, you will have to find an exit. So
not gonna happen, I think.
Please put yourself on mute. When you know, that consolidation trend was actually one of the goals of Solvency II. Solvency II is basically a far more modern way to regulate insurance companies. Solvency I was really from the Middle Age. But what I can say is it was from the Middle Age, but it worked. There was no default on the Solvency I either. So it was not really needed. Like the insurance company did not really needed such a sophisticated solvency regime. It was a good initiative overall, but it was not as if it saved the life of thousands of insurance companies. But one of the official goals was for the regulators to force mergers because Pillar 3 is really very, very cumbersome and time-consuming for the smaller guys. And so we've seen, especially among mutuals, a very, very strong trend of consolidation. Most of it is behind us. But if you are a small insurance company, you know, and if you have not yet merged or you know, you have different ways to associate yourself with other mutual groups if you are, you know, it's probably because, you know, your CEO doesn't want to share power. And when he retires, this is probably going to be the case. But I would say probably 80% of the way has been moved. The second question relates to the loss absorption mechanisms in tier one instruments. Will we see that? We could, but you need a stress scenario. I could not think of any single insurance company in Europe of a certain magnitude that would suffer this. Having said that, there was the case of Eurovita a couple of years ago. The company was taken over not by one company, but by the five largest insurance companies in Italy, and the debt instruments were not taken over. So I would say, some people say to me, okay, you say that the average expected loss default rate will be 0.1%, but what assumptions do you make on recoveries? And I always say the same thing, what do you care? Okay, if I tell you that the default rate will be 0.1%, whether your recovery are 0 or 50%, that's 5 basis point difference. Okay, we're always making assumptions here. So what matters is what's the likelihood of default? And if that is very low, you don't really care about recoveries. But never forget, it's a debt instrument, the tier ones, that have these features. So any investor should be prepared to face such an event. I'm not saying it will happen, but no one should cry because it's written on the prospectus. Okay, I think more importantly, the most important component of my answer will be the likelihood of default among insurance companies is extremely low. So I think if a tier one instrument has a loss absorption mechanism that is ever triggered, it's because basically someone has to take them over. And I think this likelihood is extremely small.
There is a last question from online, and it's just why do you focus your presentation on debt instruments instead of equity?
Okay, I focused on debt instrument instead of equity. I think I mentioned that at the beginning of the presentation, because I think that equity among insurance companies are very little volatile. I have very seldom seen an insurance company trading lower than 90% of NAV or above 110 or 120% of NAV. I think equities of insurance companies are safe, but not very sexy. And in the United States, my company has made some SPACs in the past, which is basically a special purpose acquisition corporation focusing on the insurance sector. And we've looked at basically what was available, and we decided immediately to focus on brokers, not on insurance companies. If you could measure the EBITDA of an insurance company, which is not a good KPI, I think the multiples would be very, very low. Whereas for brokers, you can have very big multiples. That's a main difference. And the other reason why I talked about debt is because I have very strong convictions on debt instruments. And I think equities, that's much more difficult to have convictions because being wrong on equities is so easy. I have never seen myself a very good equity stock picker, which means someone who beats the market 80% of times. I doubt it exists really. So the last thing I would say is I consider myself as the opposite of a guru. I never know where the trend is going, but I look at statistics, and that's why I focus my presentation on debt instruments, because I have very strong views on debt instruments. Yes.
This question related to US. Do you think that the nomination got present by Trump and his tilt towards deregulation, specifically in banks? But do you think that this attitude can spread to insurance companies at some point, trigger in the future, not short term, but trigger some kind of more risky system at some point?
So first of all, I just said I'm not a guru. So whatever Trump does or whatever influence it may have on the market, it's a big question. Not that I don't want to answer, but when Trump was elected, I said, okay, let's look at what he does. Okay, maybe some of it will be good. I just think it's impossible to know exactly what's going to happen because I've never seen anything so unpredictable. And if he continues the deregulation on banks, and if that spreads to insurance companies, it's difficult to know exactly what impact that will have on markets, because what matters on markets is not the reality, it's the perception. So you can be very right in your analysis. If others think differently, you're lost, and the market will go against you. One thing that I can mention is the insurance company is regulated, and it has to be regulated. Deregulation is always a bad thing, unless, for example, like reporting is levied and made easier for smaller companies, because you cannot ask a small company around the corner doing pet insurance with like 10,000 clients to have the same reporting level as Mapfre Seguros. That would be a nonsense. So there could be adjustments in the level of reporting depending on the size, or the importance of a bank or the importance of an insurance company. But always remember, if you have a car crash and you don't kill someone, killing is not that bad. What's bad is when you actually injure someone who cannot walk for the rest of his life. That will cost 10 million, 20 million sometimes. You don't want to pay that from your own pocket. And if your insurance company defaults, that guy will stay in a bed with no money. That is absolutely unacceptable. So insurance has to be regulated and heavily regulated. You mentioned banks. I said before to Pedro Pablo's team, I think there is a big difference between insurance and banks, not only in terms of balance sheet, but on behavior as well. What I like, and I've been in the insurance industry for 30 years, but now I'm kind of a banker, if you will. I don't like that word because I don't like it so much. But the difference between bankers and insurers is that if you looked at their brightness, how clever they are, roughly like this. But if you want to make a good deal, basically, you sell a banker. Sorry, you buy a banker at the value of its brightness and you sell it at the brightness that he thinks he is. Okay. Bankers will always think that they are smarter than what they really are, and insurers will probably think they are less smart than they really are. What is the consequence? Insurance companies very rarely take risks that they cannot control. If you look at banks, why did they default? Because usually, unless there is a lack of confidence you're linked to a withdrawal of deposits, usually it's because they have done things that they did not measure. Okay, insurance companies, when they see something that they don't understand, they just don't do it. From a behavioral perspective, that's the main difference. And if you look at one of the key insurance company having difficulty, AIG, it's not on the insurance business that they suffer, it's on the financial side. So that's what I think about future of regulation. I don't know if it answers your question, but that's my thought. Yes?
My question is related with too, especially how to include it in the analysis, because you mentioned several times the quantity of the ratio, let's say 200%.
Yes.
But do you include also in the analysis the quality of the ratio? Let's put an example. Let's say you compare two entities, same financials, but one gets this 200% of solvency ratio with a 30-40% of subordinated debt, also a high insurance quota set, and the other has not. So basically, the quality is different. How do you do this assessment in your?
No, it's a very good question. The good thing about the SCR ratio is that it's easy. Okay? It's one KPI, and everybody can understand them. Of course, a 200% SCR ratio purely made of core tier 1 equity is super strong. Why? Will only be because they can issue 50 of debt and they will reach 250. Someone with 100 of equity and 50 of debt, they are at 150. This one is really critical because, by the way, that's something I did not mention, but a tier 2 instrument, you can only redeem it once you've had the approval of the regulator. So in the example that I just gave you, someone with 100% SCR coverage ratio with core tier 1 equity and 50% with tier 2, if suddenly next year he makes a loss, he will be at 99% of equity and 50% of debt, he will be 149%. You may think, come on, that's not a major difference. From 150 to 149, what's the difference? The difference is that he cannot redeem his debt. Because the regulator will only say yes if post-redemption, you still satisfy your SCR ratio. So if it's a refinance, that's fine. But if the market is shut down, that's a big problem. That's why I never make what we call bridge financing or gap financing. You should always have core tier 1 equity of at least, okay, let's say between 130 and 150%. 130 would be for the most profitable companies that tend to pay dividends because they are so successful that they pay big dividends because they're very profitable, they're in a niche business, right? But otherwise, for a mutual, it would have to be higher than that. So I totally agree with you. That SCR ratio is a good summary, but you need to look beyond. Yes?
Yeah, but very linked to this question, do you also make additional ratios, for example, comparing the total assets with the equity, because you know that you can compute the SCR based on a standard formula, but also internal models. Some companies tend to struggle the capital, so in the end, it seems that they are very good, but in the end, they are quite volatile. We also make other ratios to make comparability between companies, for example, assets between equity or.
We make, I mean, In the company that I work for, whenever we make an analysis, we have a 25-page long current report, and we have 2 pages of KPIs at the end. One of the main ratio is the STR ratio, because it's also, for us, what will trigger the ability of the issuer to redeem. We look at the combined ratio for non-life insurance companies. We look at the total leverage ratio. Total leverage is premium plus net reserves divided by capital. It's very close to the leverage in corporations. Total balance sheet, yes, but not necessarily to compare, because even if you compare two life insurance companies, I said to you before, if you have euro policies, the quantum would be up to 10 times. If it's unit linked, it could be up to 50 times. We look at the sensitivity. So we look at the SFCR's report, and we sometimes, when we finance a company, we like them to answer our own scenarios. Because guess what? SFCR will always show results of scenarios that are quite benign. So there is no easy answer to your question, what do we look at? But I can say, if we look at the non-life insurance company, after 10 minutes, we know what questions to ask. They will not be necessarily items that you can find in the statements or in the footnotes. By the way, footnotes are much more important than statements. But if you look at the footnotes, that should be a good guide to prepare your questions. And usually, if you look at a non-life insurance company, a small one, not a big one. A big one, again, you know, it's got so many synthetic assets and liabilities that it can be a nightmare. A smaller one, typically you need to ask 10 questions, of which 3 are important, and the other 7 are maybe like, just please confirm or please clarify, but you know what the answer should be.
Maybe more than us to be on time, we have to finish here. So thank you very much all for coming. And if you have any further questions, we can stay a little bit more with you. Thank you very much, and thank you to all people that joined the conference. Thank you both.
Thank you.